All right, so you're looking to understand what a potential return to Trump-era trade policies could mean for the global economy.
Right.
And we've got just the thing for you.
Okay.
Some excerpts here from Trump's new tariffs and the Federal Reserve meeting minutes from November 28th.
Okay.
It covers potential tariffs on Mexico, Canada, and China.
Oh, wow.
The impact on the USMCA, how the Federal Reserve is reacting to inflation, and even how companies are preparing.
It's fascinating how even the suggestion of these policies is causing real ripples in the market.
Right.
Yeah, the markets are definitely on edge.
You don't exactly see trade war and think, oh, good, stability.
Yeah.
So Trump's talking 25% tariffs on everything from Mexico and Canada.
Wow.
Plus another 10% on Chinese imports.
Really?
Yeah. Not exactly subtle.
And that's the point, isn't it?
Right.
Even if it's a negotiating tactic,
Right.
the uncertainty alone is causing the Canadian dollar to dip. Just think about it.
Yeah.
Mexico, Canada, China, they represent almost $2 trillion in U.S. trade.
Wow.
It's not chump change. And the disruption would be huge.
It's like someone's throwing a boulder into a very still pond.
Right.
And Mexico and Canada, they aren't just standing there getting splashed.
No, they're not.
They've their responses have been pretty pointed.
Exactly. And it's more than just words.
Yeah.
There are hints at counter tariffs.
Right.
Which could escalate things rapidly.
Oh, wow.
Moody's has already lowered Mexico's GDP growth forecast, directly citing this uncertainty.
But isn't Canada in an even more precarious position?
Yeah.
I mean, they're so tied to the U.S. economy.
You're absolutely right.
Yeah.
They're our biggest oil supplier, and we're talking $2.6 billion in trade daily.
Wow.
One economist is predicting a 25% tariff could shrink their GDP by 2.6%.
Wow.
Potentially pushing them right into a recession.
Wow.
Talk about feeling the squeeze.
Now let's throw USMCA into the mix.
Okay.
So this replaced NAFTA back in 2020. Focused on labor, regional sourcing, digital trade, the whole 9 yards.
The irony here is thick.
Yeah.
Trump championed USMCA as this huge victory for the U.S.
Right.
And now he's talking about renegotiating.
Wow.
He's pointing to Mexico's auto industry ties to China and Canada's protection of their dairy and poultry.
So is this genuine economic concern?
Right.
Or is it maneuvering for when USMCA comes up for review in 2026?
Yeah.
You know, trying to get a head start?
It's hard to say definitively.
Right.
It could be both, right?
Right.
But there's certainly a strategic element at play here,
Right.
trying to secure some leverage for those future talks.
Okay, so let's address the elephant in the room.
Oh, okay.
Or rather, the myth in everyone's mind when we talk tariffs. Who's actually paying?
This is crucial.
Yeah.
It's not the exporting country that takes the hit.
Right.
It's the importing companies here that pay those tariffs.
Right.
And those costs.
Yeah.
They get passed right down the line to consumers. Think about it.
Yeah.
Mexican produce at the supermarket.
Yeah.
Canadian lumber for construction.
Right.
You're feeling it at the checkout.
That's not just a splash in the pond.
No.
That's feeling the whole tidal wave.
Right.
And I saw Goldman Sachs is estimating a 0.75% price increase.
Wow.
Across the board if these tariffs go through.
Yeah.
That's like $1,000 a year out of the average U.S. household's pocket.
Precisely.
Wow.
And that's on top of inflation. That's already biting into people's budgets.
Yeah.
It's a double whammy.
I'm getting a serious case of deja vu here.
Yeah.
Are U.S. companies reacting the same way they did back in 2018?
Yeah.
When this all kicked off before?
The patterns are definitely repeating.
Right.
The IMF's analysis shows that back then, businesses stockpiled like crazy.
Right.
Before the tariffs hit.
Wow.
It caused a temporary surge in imports, actually widening the trade deficit in the short term.
Wow.
Recent export data from China suggests that's happening all over again. You might already be seeing this yourself.
Yeah.
Shelves looking a little bare, prices creeping up.
Yeah.
That's those tariffs at work.
Right.
Pushing companies to stockpile.
Right.
Before costs get even higher.
So it's not just stockpiling, right?
Absolutely not.
Companies are pulling out their whole bag of tricks to deal with this.
Absolutely.
We're seeing companies raising prices, diversifying their suppliers,
right,
and maybe, most significantly, speeding up that shift away from manufacturing in China.
Yeah.
The big question is, are these just short-term Band-Aids?
Right.
Or is this a genuine reshaping of the landscape? And what does it mean for global supply chains?
Right.
And ultimately what you're paying for goods?
Yeah, that's the big question.
Big questions indeed.
Yeah.
It's not just about what we're buying.
Right.
The Federal Reserve's in the hot seat, too.
Definitely.
They just cut interest rates.
Uh-huh.
But their meeting minutes make it clear they're walking a tightrope.
Yeah, it's a real balancing act. They want to lower rates further to stimulate the economy.
Right.
But they're terrified of inflation spiking again.
So what's the dilemma? Well, what are they wrestling with?
The labor market is holding up well.
Right.
Productivity is actually improving.
Okay.
But core inflation is stubbornly high.
Right.
They're trying to find that neutral rate where their actions don't rock the boat too much in either direction.
Right.
Problem is, nobody's quite sure where that sweet spot is.
Which makes investing right now feel like playing roulette, right?
Pretty much.
So given the Fed's current stance, what's an investor to do? Any actionable insights from our source material?
A couple of things stand out. Bond letters are worth considering.
Yeah.
You can lock in today's decent yields while staying flexible if rates drop further down the line.
Okay.
Also, look at sectors that benefit from stable rates,
Okay.
like utilities and consumer staples. Historically, those have outperformed during these easing cycles, with returns in the 9–12% range annually.
Solid advice.
Thank you.
We've covered a lot of ground here.
We have.
Immediate threats of trade wars, the Fed's long game.
Yeah.
It's a lot to process.
It certainly is.
But understanding these dynamics is key to navigating this volatile landscape.
Absolutely.
Exactly.
It is.
We've got more to unpack.
Okay.
But let's pause here for a moment.
Sounds good.
More to come in just a bit.
Looking forward to it. It really is, and there's another layer to this whole situation that we should explore.
Okay.
We've talked about how these tariffs could impact everything, from grocery prices to the value of the Canadian dollar.
Yeah.
But what about the potential for reshoring?
Okay.
Bringing manufacturing back to the U.S.
That's right. It was a big part of Trump's platform for bringing those manufacturing jobs back.
Exactly.
But is that actually feasible on the scale he's talking about?
That's a great question. And honestly, the source material doesn't delve too deep into it, but it is something to consider.
Okay.
While the idea of reshoring sounds appealing on the surface, there are a lot of potential pitfalls to think about.
Right.
Unintended consequences that we need to be aware of.
Like, could it actually drive up prices for consumers even more?
Exactly.
If production costs in the U.S. are higher,
right.
wouldn't that kind of defeat the purpose?
Exactly. And what about the workforce?
Right.
Would we have enough skilled labor in the U.S. ready to step into those manufacturing roles? It's not as simple as just flipping a switch.
And what about the environmental impact? Would shifting manufacturing back to the U.S. actually increase our carbon footprint?
Potentially, yeah.
Depending on the industry?
Yeah.
There are so many factors.
You're hitting on some really important points.
Yeah.
These are complex issues with no easy answers.
Right.
It's vital to consider the potential downsides alongside the potential benefits.
Yeah, absolutely.
Absolutely.
Okay, let's shift gears back to the source material for a second.
Okay.
One thing that really jumped out at me was how Mexico has become the U.S.'s top trading partner.
Yeah.
Even surpassing China.
It is fascinating.
What's driving that shift?
It's a fascinating development.
Yeah.
The source material points to the tariffs on Chinese goods during Trump's first term as a major factor.
Right.
Remember that line chart showing the percentage of U.S. goods imports?
Yeah.
China's share has dropped significantly since those tariffs went into effect, while Mexico's has been steadily climbing.
So are these tariffs actually working as intended then?
Right.
Are they shrinking the trade deficit and boosting U.S. manufacturing?
That's where things get a little more complicated. While imports from China have decreased, the overall volume of U.S. imports hasn't really gone down. Instead, we're seeing a diversification of supply chains with companies sourcing goods from other countries like Vietnam, India, and South Korea.
So it's like a game of whack-a-mole.
That's a great analogy. You try to suppress trade from one country, and it just pops up somewhere else.
And the source material emphasizes that the U.S. trade deficit hasn't really shrunk despite the tariffs.
Exactly.
So this raises a big question. Are these tariffs truly effective in achieving their stated goals? Or are they creating more problems than they solve? Are we just shuffling the deck chairs on the Titanic?
That's the million-dollar question that economists are debating right now, and there's no easy answer. It's a complex issue with far-reaching consequences.
Speaking of those consequences, let's talk about how businesses are adapting to this constantly shifting trade landscape.
Sure.
The source material mentions strategies like stockpiling, raising prices, diversifying suppliers, and moving manufacturing away from China. But are those sustainable solutions?
That's a really good question.
Yeah.
And it's important to note that each of those strategies comes with its own set of challenges and risks.
Right.
Stockpiling, for example, can disrupt supply chains and lead to price volatility.
Okay.
Raising prices could make U.S. goods less competitive on the global market. And diversifying suppliers, while necessary, can increase costs and logistical complexities.
It sounds like companies are stuck between a rock and a hard place. Trying to navigate this unpredictable environment.
Yeah, they are.
And keep their businesses afloat.
Exactly. And the source material highlights how all of this uncertainty is impacting investor confidence.
So what's the takeaway for the average person listening to this? How can they make sense of all this and maybe even make some informed decisions about their own finances? Like, what can they do?
Well, first and foremost, stay informed. Understand how these trade policies could potentially impact the economy as a whole, specific industries, and even your own household budget. Knowledge is power, especially in situations like this.
Don't just bury your head in the sand and hope for the best.
And secondly, think about diversifying your investments. Don't put all your eggs in one basket, as the saying goes. Look for opportunities in sectors that are less likely to be disrupted by trade wars. Things like healthcare or domestic consumer goods.
So maybe think twice before going all in on those tech stocks that rely heavily on global supply chains. Until things settle down a bit.
Exactly.
Okay.
It's about managing risk and making smart decisions based on the information you have.
Now, we've been talking a lot about the potential negative impacts of these tariffs.
But
it's only fair to acknowledge that some argue there could be upsides as well.
Of course. Some argue that tariffs can protect domestic industries from unfair competition. Encourage companies to invest in domestic production and ultimately create more jobs here in the U.S.
That's a valid point. It's not all doom and gloom.
Exactly.
But the question remains, do the benefits outweigh the costs?
That's the debate, isn't it? And one that economists and policymakers are going to continue having.
And we'll continue to follow it closely.
Absolutely.
And bring you the insights you need to make sense of it all.
We will.
Okay. Before we wrap up part 2,
I
want to circle back to something we touched on earlier. The Federal Reserve's Balancing Act feels like they're juggling chainsaws on a tightrope.
It's a tough spot to be in. Trying to control inflation without stifling economic growth. And their latest meeting minutes offer some clues about how they're thinking.
So what are the key takeaways? What should investors be paying attention to?
Well, for one, the Fed is signaling a more cautious approach to future rate cuts. Especially if inflation doesn't start to cooperate.
So no more aggressive rate cuts like we've seen recently?
Not necessarily. They're keeping their options open, but they're also stressing the need to be patient and data-driven. They don't want to make any hasty moves. That could jeopardize the progress they've made in combating inflation.
That makes sense. Trying to walk that fine line between stimulating the economy and keeping inflation under control.
Exactly. And the minutes also highlight some key uncertainties that are giving the Fed pause.
Like what? Fill us in?
Well, they're still not entirely sure what the neutral rate is. Remember, that's the interest rate level that neither stimulates nor hinders economic growth.
So they're making these huge decisions with incomplete information.
Well, it's not that they're flying blind. But there's always going to be a level of uncertainty in economics. They're using all the data they have to make informed decisions. But it's not a perfect science.
And what about the labor market? Is that a concern for them?
It is. The minutes acknowledge that the labor market has been remarkably resilient, but they're also keeping a close eye on it for any signs of weakness. Remember, a strong labor market can actually fuel inflation. If wages start rising too quickly, it's all connected.
It sounds like everything's intertwined.
It is.
The labor market, inflation, interest rates, trade policy, a complex web that the Fed has to untangle.
Exactly.
Yeah.
And that's why it's so important for investors to stay informed.
Right.
And understand the bigger picture.
Yeah.
The interplay of all these different forces.
Absolutely. Now, before we move on to part 3 of this deep dive, I want to leave our listeners with something to ponder.
Go for it.
If Trump's trade policies lead to higher prices for consumers, could that actually backfire on him politically?
No, that's an interesting question.
Yeah.
Voters tend to be pretty sensitive to changes in their wallets.
Right.
Especially when it comes to things like groceries and gas.
Exactly.
Yeah.
It'll be interesting to see how all of this plays out in the coming months and years.
It certainly will.
Yeah.
Okay, let's take a quick break and we'll pick up this thread in part 3.
It really is. You know, you want to strengthen American businesses and workers.
Yeah.
But could end up hurting the very people you're trying to help.
Absolutely. It's a delicate balancing act.
Right.
And I think we've seen time and again that there can be unintended consequences when it comes to economic policy.
Speaking of unintended consequences, what about the impact on investors?
Yeah.
Our source material does offer some insights into how to navigate this uncertain terrain.
Yes, and one key takeaway for investors
is
the importance of diversification. Now more than ever, you don't want to put all your eggs in one basket.
Right.
Especially in those sectors that are heavily exposed to trade risks.
So maybe ease up on those tech stocks that rely on complex global supply chains,
right?
At least for the time being.
That's one approach, yeah.
Okay.
Consider diversifying into sectors that are less sensitive to trade wars,
right?
Like healthcare, utilities, or consumer staples. Those tend to be more stable and less impacted by global economic turmoil.
Makes sense. What about bonds?
Yeah.
Are those a safe haven in this kind of environment?
Bonds can definitely play a role in a diversified portfolio.
Okay.
But it's important to be strategic about your choices.
Right.
The source material suggests considering bond ladders as a way to lock in today's relatively high yields while staying flexible in case rates drop further.
Bond ladders. For those who might not be familiar with that term, could you break it down for us?
A bond ladder is essentially a portfolio of bonds with different maturity dates.
Right.
So instead of buying one bond that matures in, say, 10 years, you might buy several bonds that mature in 2, 5, 7, and 10 years.
Okay.
This spreads out your risk and allows you to reinvest those maturing bonds at potentially higher rates down the line if interest rates go up.
That's a pretty clever strategy.
Yeah.
It's like building a safety net into your bond portfolio.
Exactly.
Okay. And another suggestion from the source material is to consider exploring opportunities in emerging markets.
Yes.
Emerging markets.
Yes.
Isn't that a bit risky given all the global uncertainty we've been talking about?
Well, there's always an element of risk involved in investing.
Right.
But emerging markets can offer some significant growth potential, especially as companies look to diversify their supply chains away from China. Countries like Vietnam, India, and Indonesia are becoming increasingly attractive to investors.
So it's about finding those pockets of opportunity within the turmoil.
That's a great way to put it. And, of course, it's always wise to consult with a financial advisor to develop an investment strategy that aligns with your specific goals and risk tolerance.
Solid advice.
Yeah.
Now, before we wrap up this deep dive,
I
want to leave our listeners with one final thought to consider.
Okay.
It feels like we're entering a new era of global trade. One characterized by uncertainty, volatility, and shifting alliances.
It's true.
It's almost uncharted territory.
It's a fascinating and at times a little bit unnerving landscape.
Right.
The old rules of the game no longer apply.
Right.
And we're all trying to figure out what the new rules will be.
Which is why it's so important to stay informed.
Absolutely.
To think critically and to be adaptable.
Yeah.
We have to be prepared to adjust our strategies as the world around us continues to change.
Couldn't agree more. Change is the only constant. And those who can embrace it and adapt will be the ones best positioned to thrive in this new era.
Well said. And on that note, a huge thank you to you, our listeners, for joining us on this deep dive into the complex world of trade wars, economic policy, and the ever-shifting landscape of global commerce. We hope you found this exploration insightful and, most importantly, empowering. Until next time, stay curious, stay informed, and keep tapping deep.